So this is the final session of the ARC conference. It's a panel discussion. This is a case in which there is absolutely no need to introduce the speakers, so I shall not do that. This is also a case in which the chair can think of a long list of questions which should be answered by the panel, but stands very little chance of having them take the list seriously. So I decided I would basically ask for two meta questions. The first one is, what are the lessons that one should draw from the crisis or the crises? I suggested 3, but the number can be negotiated. And then the second question is, are we ready for the next one? And with this in mind, we'll basically proceed in order. I think of about first round of 15 minutes each or something like this. And the first is Ben Bernanke, please.
Thank you, Olivier. I'm very pleased to participate in this event in the honor of Stanley Fischer. Stan was my teacher in graduate school, and he's been both a role model and a frequent advisor ever since. An expert on financial crises, Stan has written prolifically on this subject and has also served on the front lines, so to speak, notably in his role as first deputy managing director of the IMF during the emerging market crises of the 1990s. Stan also helped to fight hyperinflation in Israel in the 1980s, and as governor of that nation's central bank, he deftly managed monetary policy to mitigate the effects of the recent crisis on the Israeli economy. Subsequently, as Israeli housing prices moved upward, Stan became an advocate and early adopter of macroprudential policies to preserve financial stability. Stan frequently counseled his students to take an historical perspective, which is good advice in general, but particularly helpful for understanding financial crises, which have been around for a long time. Indeed, as I've noted elsewhere, I think the recent global crisis is best understood as a classic financial panic transposed into a novel institutional context of 21st century financial system. An appreciation of the parallels between recent and historical events greatly influenced how I and many of my colleagues around the world responded to the crisis. Besides being the 5th anniversary of the most intense phase of the recent crisis, this year also marks the centennial of the founding of the Federal Reserve. It's particularly appropriate to recall, therefore, that the Federal Reserve itself was created in response to a severe financial panic, the Panic of 1907. This panic led to the creation of the National Monetary Commission, whose 1911 report was a major impetus to the Federal Reserve Act, signed into law by President Woodrow Wilson on December 23, 1913. Because the Panic of 1907 fit the archetype of a classic financial panic in many ways, it's worth discussing the similarities and differences with the recent crisis. Like many other financial panics, including the most recent one, the Panic of 1907 took place while the economy was weakening. According to the NBER, a recession had begun in May of 1907. Also, as was characteristic of pre-Federal Reserve panics, money markets were tight when the panic struck in October, reflecting the strong seasonal demand for credit associated with the harvesting and shipment of crops. The immediate trigger of the panic was a failed effort by a group of speculators to corner the stock of the United Copper Company. The main perpetrators of the failed scheme, F. Augustus Heinz and C.F. Morse, had extensive connections with a number of financial institutions in New York City. When the news of the failed speculation broke, depositor fears about the health of those institutions led to a series of runs on the banks, including a bank at which Heinz served as president. To try to restore confidence, the New York Clearing House, a private consortium of banks, reviewed the books of the banks under pressure, declared them solvent, and offered conditional support, one of those conditions being that Heinz and his board step down. These steps were largely successful in stopping runs in the New York banks. But even as the banks stabilized, concerns intensified about the financial health of a number of so-called trust companies, financial institutions that were less heavily regulated than national or state banks and which were not members of the clearinghouse. As the runs on the trust companies worsened, the companies needed cash to meet the demand for withdrawals. In the absence of a central bank, New York's leading financiers, led by J.P. Morgan, considered providing liquidity. However, Morgan and his colleagues decided they did not have sufficient information to judge the solvency of the affected institutions, and so they declined to lend. Overwhelmed by a run, the Knickerbocker Trust Company failed on October 22nd, underwriting public confidence in the remaining trust companies. To satisfy their depositors' demands for cash, the trust companies began to sell or liquidate assets, including loans made to finance stock purchases. The sell-off of shares and other assets in what today we would call a fire sale precipitated a sharp decline in the stock market and widespread disruptions in other financial markets. Increasingly concerned, Morgan and other financiers, including the future governor of the Federal Reserve Bank of New York, Benjamin Strong, led a coordinated response that included the provision of liquidity through the clearinghouse and the imposition of temporary limits on depositor withdrawals, including withdrawals by correspondent banks in the interior of the country. These efforts eventually calmed the panic. By then, however, the U.S. financial system had been severely disrupted and the economy contracted through the middle of 1908. The recent crisis echoed many aspects of the 1907 panic. Like most crises, the recent episode had an identifiable trigger. In this case, the growing realization by market participants that subprime mortgages and certain other credits were seriously deficient in their underwriting and their disclosures. As the economy slowed and housing prices declined, diverse financial institutions, including many of the largest and most internationally active firms, suffered credit losses that were clearly large, but also hard for outsiders to assess. Pervasive uncertainty about the size and incidence of losses in turn led to sharp withdrawals of short-term funding from a wide range of institutions. These funding pressures precipitated fire sales, which contributed to sharp declines in asset prices and further losses. Institutional changes over the past century were reflected in the differences in the types of funding that ran. In 1907, in the absence of deposit insurance, retail deposits were much more prone to run, whereas in 2008, most withdrawals were of uninsured wholesale funding in the form of commercial paper, repos, and securities lending. Interestingly, a steep decline in interbank lending, a form of wholesale funding, was important in both episodes. Also interesting was that the 1907 panic involved institutions, the trust companies, that faced relatively less regulation, which probably contributed to their rapid growth in the years leading up to the panic. In analogous fashion, in the recent crisis, much of the panic occurred outside the perimeter of traditional bank regulation in the so-called shadow banking sector. The responses to the panics of 1907 and 2008 also provide instructive comparisons. In both cases, the provisions of liquidity in the early stages was critical. In 1907, the United States had no central bank, so the availability of liquidity depended on the discretion of firms and private individuals like J.P. Morgan. In the more recent crisis, the Federal Reserve fulfilled the role of liquidity provider consistent with the classic prescriptions of Walter Bagehot. The Fed lent not only to banks, but seeking to stem the panic in wholesale funding markets, it also extended its lender of last resort facilities to support non-bank institutions, such as investment banks and money market funds, and key financial markets, such as those for commercial paper and asset-backed securities. In both episodes, though, liquidity provision was only the first step. Full stabilization required the restoration of public confidence. Three basic tools for restoring confidence are temporary public or private guarantees, measures to strengthen the balance sheets of financial institutions, and public disclosure of the conditions of financial firms. At least to some extent, Morgan and the New York Clearinghouse used these tools in 1907, giving assistance to troubled firms and providing assurances to the public about the conditions of individual banks. All these tools were used extensively in the recent crisis. In the United States, guarantees included the FDIC's guarantees of bank debt, the Treasury Department's guarantees of money market funds, and the private guarantees offered by stronger firms that acquired weaker ones. Public and private capital injections strengthened bank balance sheets. And finally, the bank stress test that the Federal Reserve led in the spring of 2009 and the publication of the stress test findings helped restore confidence in the U.S. banking system. Collectively, these measures helped end the acute phase of the financial crisis, although 5 years later, the economic consequences are still with us. Once the fire is out, the public turns to the question of how to better fireproof the system. Here, the context and the responses differed between 1907 and the recent crisis. As I mentioned, following the 1907 crisis, reform efforts led to the founding of the Federal Reserve, which was charged both with preventing panics and with providing an elastic currency to smooth seasonal interest rate fluctuations. In contrast, reforms since 2008 have focused on critical regulatory gaps revealed by the crisis. Notably, oversight of the shadow banking system is being strengthened through the designation by the Financial Stability Oversight Council of non-bank SIFIs, or systemically important financial institutions, for consolidated supervision by the Fed, and measures are being taken to address the potential instability of wholesale funding, including reforms to money market funds and the tri-party repo market. As we try to make the financial system safer, we must inevitably confront the problem of moral hazard. The actions taken by central banks and other authorities to stabilize a panic in the short run can work against stability in the long run if investors and firms infer that they will never bear the full consequences of excessive risk-taking. As Stan Fischer reminded us following the international crises of the late 1990s, the problem of moral hazard has no perfect solution, but steps can be taken to limit it. First, regulatory and supervisory reforms such as higher capital and liquidity standards or restrictions on certain activities can directly limit risk-taking. Second, through the use of appropriate carrots and sticks, regulators can enlist the private sector in monitoring risk-taking. For example, the Federal Reserve's CCAR process, the descendant of the bank stress test of 2009, requires not only that large financial institutions have sufficient capital to weather extreme shocks, but also that they demonstrate that their internal risk management systems are effective. In addition, the results of the stress test portion of CCAR are publicly disclosed, providing investors and analysts the information they need to assess banks' financial strength. Of course, market discipline can only limit moral hazard to the extent that debt and equity holders believe that in the event of distress, they will bear costs. In the crisis, the absence of an adequate resolution process for dealing with a failing SIFI left policymakers with only the terrible choices of a bailout or allowing a potentially destabilizing collapse. The Dodd-Frank Act, under the Orderly Liquidation Authority of Title II, created an alternative resolution mechanism for SIFIs that takes into account both the need for moral hazard reasons to impose costs on the creditors of failing firms and the need to protect financial stability. The FDIC, with the cooperation of the Federal Reserve, has been hard at work fleshing out this authority. A credible resolution mechanism for systemically important firms will be important for reducing uncertainty, enhancing market discipline, and reducing moral hazard. Our continuing challenge is to make financial crises far less likely, and if they happen, far less costly. The task is complicated by the reality that every financial panic has its own unique features that depend on a particular historical context and the details of the institutional setting. But as Stan Fischer has done with unusual skill throughout his career, one can, by stripping away the idiosyncratic aspects of individual crises, hope to reveal the common elements. In 1907, no one had ever heard of an asset-backed security, and a single private individual could command the resources needed to bail out the banking system. And yet, fundamentally, the panic of 1907 and the panic of 2008 were instances of the same phenomenon, as I've discussed today. The challenge for policymakers is to identify and isolate the common factors behind crises, allowing us to prevent crises when possible and to respond effectively when not. Thank you.
Thank you, Ben. Next speaker is Stan Fischer.
I'd like to thank the IMF for organizing this conference and for giving me the privilege to have a conference named in honor of me. and it's actually been a great conference. Lots of practical papers on lessons we've learned from recent crises and from earlier crises, particularly comparison of the difference between the Asian crisis of the late 90s and the crisis that began in 2008. And I commend the papers from this conference to those of you who were not able to be here to listen to them. I'd also like to thank Ben Bernanke for everything he's done as chairman of the Fed. I believe that when the history books get written, the innovations that were made in this crisis will be recognized as changing the way in which central banks deal with financial crises. And I'll have to, and Olivier has asked us to speak about some of those ways, and he told us 3. So I'll talk about 3 features of the changes that will occur, I think, in our thinking if we remember them. There is this line that those who do not learn history are condemned to repeat it. Frank Knight, the inventor of risk as opposed to, of uncertainty as opposed to risk, had a lot of one-liners which he used on everything. And his one-liner on that line was, and those who do remember history are also condemned to repeat it. So I hope we're not. What are the 3 things I'm going to talk about? The first, that what the textbooks say when they write about the Keynesian model or the ISLM model is fundamentally right, but what we have learnt this time is that monetary policy does not in fact necessarily lose its effectiveness at the zero lower bound, and that there's a lot that the central bank can do to continue to support the economy even when the central bank interest rate is effectively 0. That we know from what the Fed has done in this crisis, the quantitative easing programs in particular. There is controversy about how effective those programs are. There's also been a large amount of empirical work done on the effectiveness of those programs. Ben, in his 2011 Kansas City speech, actually gave a list of the empirical work that had been done on these issues, and it's very hard to reach the conclusion that the unorthodox measures are ineffective. They appear to be effective, and they essentially do that by working off either the provision of liquidity in markets where liquidity has dried up, or by changing interest rates other than the central bank interest rate, moving, for instance, in markets where longer-term interest rates are determined. So in addition, in this context, the Fed tried to invent a concept, to name a concept called credit easing. I'm not sure what credit easing was meant to be, but it is very close to the concept of the central bank as market maker of last resort, as opposed to the central bank as lender of last resort. And we saw the Fed acting in that role in, for instance, the commercial paper market very early in the crisis when that market dried up, and a very important source of financing, short-term financing for corporations appeared to be unavailable, and the Fed went in and revived that market effectively by buying commercial paper in appropriately large quantities. And there have been other examples of the Fed as market maker of last resort, or at least contributor to making markets in, for instance, its current quantitative easing emphasis on mortgage-backed securities. So I think the textbooks will have to say something other than what they used to say. And this is to tell you that the 12th edition of Dornbusch, Fischer and Start's will appear shortly. And we'll note that the previous sentence, when the central bank interest rate reaches 0, you have to switch to fiscal policy, is not entirely correct, that you can keep going with both monetary and fiscal policy. And if you don't want to call it monetary, you can call it central bank policy. Second lesson, it is better to fix banking and debt problems rapidly than to rely on regulatory forbearance. This is a lesson that we knew and learned in the Asian crisis, and it was understood by policymakers in the United States. It was understood in particular by the speed with which the United States dealt with problems of the banking system via the stress tests, which were undertaken very early after the collapse of Lehman Brothers. That was really remarkably quick that those actions were undertaken. I had thought, when I read about it from a distance, that the Fed was possibly taking a significant risk in undertaking those tests and being willing to publish the results because the results had been bad. I thought the consequences would be serious, but this in fact was not the case, as explained to me by someone else, because of the top, the system had the capital to recapitalize the banks. If that had been what was needed and what was revealed by the stress tests. And that illustrates a problem with, or the contrast between what was done in the banking system in the United States and what was done in the banking system in Europe, in which at this stage the dealing with the problems of the banking systems has been left to national regulators, and they're only now moving into the banking union, and they're doing an asset quality review, that is to say an examination of the quality of the assets that the banks hold, which is to say an assessment of the quality of the capital that they hold, and then we'll move into the banking union. I think before we all roll our eyes and say how very slow, we need to realize that making a massive structural change, like setting up a European banking union, at the same time as you're dealing with a massive crisis in the banking system, is not a trivial enterprise. And I don't believe that the schedule they're on is particularly slow given the situation, but I do believe that the minimum slowness that we're seeing now is holding back European recovery, and that the quicker that can be done, the better that would be. I think the third lesson we've learned is that the financial system is a system, and it needs to be regulated on that basis, which is the underlying rationale for macroprudential supervision and for the concept of macroprudential supervision. That is that the system, the regulatory system, needs to ask itself what are the interactions within the financial system that could lead to problems over and beyond those that would arise for individual banks that got into trouble. And of course, the quintessential example is the Lehman Brothers crisis, a bank which was thought of being of moderate size and possibly not quite, it's possibly not being quite comprehended just how extensive its interactions, how that event led to a very widespread global, what was followed by a widespread global financial crisis. And there is no question but that in every country the emphasis has shifted now, or there's been an addition of a discussion of how to do macroprudential supervision. Now this is very hard because in almost every country there are multiple regulators. And in Israel there were 3, and getting the 3 to cooperate was very hard. In fact, it hasn't been quite achieved yet. The United States has many more regulators, and a framework has been set up to get them to cooperate, and one very much hopes that that will be possible. Now, in the end, the central bank has a central role to play in most of these, in that type of supervision, because in the end, it is likely or not impossible that you will end up looking to the central bank to act as lender of last resort where that is legally possible. And so the central bank has to be one of the central elements in building the macroprudential supervision and the system of macroprudential supervision. Treasuries always are, because when banks are insolvent, you begin to deal with calls on the public purse, and those typically require treasury participation. So those are 2 essential elements. The rest of the institutions also need to be supervised, and then the rest of this system, which is called the shadow banking system, but there'll always be a shadow banking system, even if we succeed in pulling the current unregulated institutions into a regulated network. Something else will emerge outside that system as a way of avoiding the regulations and taking advantage of the avoidance of those regulations. So it's going to take a lot more work to get the macroprudential systems working. I believe that the way the Bank of England has done this is promising, and we'll just have to watch how well that works. The Bank of England has a financial policy committee as well as a monetary policy committee, and the financial policy committee has a slightly different membership than the monetary policy committee. The chairman, the governor of the central bank is the chairman of both committees, and the financial policy committee has the responsibility by law for supervising the entire financial system. And we're going to have to watch how that works. That takes me over to the second set of questions that Olivier asked, which is, are we better equipped to deal with the next crisis? And the answer is we are better equipped in the areas we've dealt with and helped set up improved systems. But the harder answer is that it's very hard to know until you do a lot of stress tests, and that the ultimate stress test is in fact what reality throws you away. It's hard to be sure. I think, for example, of the fact that the financial authority set up by the British in 1997, which was very elegantly done, convinced many people that this was the way to go. That was what you should do, a financial supervisory authority outside the central bank, charged with responsibility. I know one think you're macroprudential, but the idea was the same. Charged with that responsibility would be the right answer. Well, it was not subjected to a test of reality until 2007 or 8 with the Northern Rock crisis, and it didn't succeed. It was followed by the first bank runs in Britain in 140 years. And so we will not know for sure whether systems that have been set up are in fact capable of dealing with the tests they may face. But what we certainly can do is stress test those systems and set up a variety of exercises in which they are examined under circumstances which they can think up, outside experts can be asked to think up, or others can be asked to think up, and to ask, how would we deal with this crisis? How would we deal with that crisis? What powers do we have that we need? What powers do we not have that we need? And I think we will have to stress test the regulatory systems as well as the financial systems. So that is one concern, that in that area and in others, the measures we have undertaken, we won't know how effective they are until they're actually stress tested by experience. And there is, of course, another problem, which is, as has been emphasized today, crises have many different sources. And generals prepare for the last war. Economists prepare for the last crisis. And sometimes the last war is very similar to the next war. And sometimes it isn't. And I spent a lot of my time as governor looking in the direction my eyes could see and being sure that something was coming up right behind me. And there was going to be some crisis which none of us had thought about and which would hit us with considerable force. The 2008 crisis was not like that, except in one sense. If you'd asked me in 1997, and I know this because I wrote about it, do I expect to have a major global crisis, financial crisis, start in the advanced countries, I would have probably said no. And so in that sense, it was a surprise. Of course, as time wore on and we got to 2007, 2008, the presence of that crisis became less implausible, and it eventually became a fact. But we will need to keep asking ourselves, and again, we have to do this by actually sitting down and asking how we would deal with a variety of problems if they should occur. We'll have to do those things and keep on doing them, because financial crises originate in many different places. Economic crises originate in even more different places. And we need to keep asking ourselves, what else is it that we need to think about and deal with to make the economy operate with fewer crises and with greater stability? Thank you.
Our next speaker is Ken Rogoff.
Thank you very much. It's an extraordinary pleasure to speak at this event in honor of Stan Fischer and his many contributions as a scholar, as a policymaker. I think all of us here who have worked with Stan, would recognize him both as an economist, and then he became a policymaker's policymaker. And if I can comment on the first, when I was a graduate student and maybe just a bit after, there was sort of like a war going on in macroeconomics between the new neoclassicals and what I guess Greg Mankiw, who was sitting here later, termed the new neo-Keynesians, of what was the right way to model things. And we needn't get into the details, but they just completely disagreed with each other. And it felt like the only person that both sides respected was Stan Fischer. He would sit there in the middle. I must say maybe John Taylor also was there. But, and I was just, aghast at that, of how he managed this. I should say this was resolved by both sides deciding they were right and continuing to believe they were right. But that's another story. And then we've heard a lot of talk, of course, of Stan as a policymaker's policymaker. I've had a professional lifelong experiences with Stan, and many people have spoken. I will say, one thing I learned from him was, and also I think not as both as on the staff, I was chief economist, and also when I was a student, is he's very engaged, which Ratna Sahai said at lunch, but also he has a very good way of balancing praise and constructive criticism, which is a very hard thing to do, both as a boss and as a professor, and really shows his class in doing that. I will go on to take up the topic. I'm on the podium with 4 men who've had extraordinary experience in dealing with financial crises. They're all going to be historic figures. And rather than go on to a couple narrow lessons about that, which I think maybe would be for another occasion, and maybe other people have said, I want to pick a couple of points. And I would say, number one, if you think that you're dealing with a liquidity crisis, and I'll come to that, but if you really think that is, and it might be systemic, this might be something that's really going to, bring down a region, bring down the economy, you need to react very forcefully and very creatively. And I think all of these gentlemen have showed extraordinary creativity. Early on in his policy career, Larry Summers dealt with the Mexican crisis, and Stan, I think you had just arrived at the fund when that happened. And one of the things that was done was they came up with money out of nowhere. The exchange rate stabilization fund in the US was somehow used to bail out Mexico. Congress at that time didn't realize they could do that and hadn't stopped them. And they even generated some faux loans from across the street. And I remember Larry, I was talking with him about it, really we're probably still in the late 90s. He was, I think, visiting us at Princeton, and maybe he was, sitting with me talking, and he said, well, you would have done that, right? And I go, yeah. It was very creative. And certainly you can look at some of the things that Stan did during the Asian crisis, more recently with policies with Israel, where it isn't just a question of courage, it's a question of thinking of it, that you might do it. And of course, it would be hard sitting here with Ben Bernanke, who all of his former academic colleagues have commented on just the extraordinary creativity the Fed did during the crisis, just doing things just nobody imagined. Stan talked about some of them. I have to remember waking up one day and finding out that they'd made the investment banks into banks so they could bail them out. And I thought I was living in an alternate universe or something. It was, really, this is way out of the box thinking. And Olivier, I won't pick on you so much because you're still in the thick of it, but the 4% inflation target, people said you were crazy, and now maybe not so much. I guess one of the problems that you have practically as a policymaker that all of them have faced is that when it's a liquidity crisis, and you just know it's a liquidity crisis, okay, you print money, you generate money, you bail them out. The fact is there are very few crises that really fit the diamond div vig mold. We teach that model because it's so simple and nothing else is going on. But actually, there are other models, and I think of the Alan Gale model, which commingles solvency and liquidity crises. It's much more complicated, so people don't teach it so much. But of course, in the real world, they are. It's a question of how much is a solvency crisis, how much is a liquidity crisis. And I know when I was in the fund, and here from 2001 to 2003 as chief economist, and involved in some of these, you'd go around the table. It's a liquidity crisis. It's a solvency crisis. It's a liquidity crisis. And of course, you reach completely different conclusions on what you're going to do. These are things where very difficult judgments are made. And coming back to something Jeff Sachs said earlier, I think is very, very important, which is you have to have the diagnosis. You need some information. And I must say, there are cases where the patient arrives in the emergency room and hasn't seen a doctor, for some chronic condition which has now become severe. It's a lot harder to treat the patient, and there's certainly been cases like that. So extraordinary creativity is one lesson. I would say certainly another one is if it's a liquidity crisis, overwhelming force. You don't stop to wonder what's going to work. You do everything, and I think we saw that particularly in the 2008 crisis. you throw the kitchen sink. If that doesn't work, the cabinets, the chair, the tear up the tiles, try to save your family. But you do everything that's possible. Now, as Olivier framed the question, it was something, what do you do after the crisis? And I think that hits on one of the problems. When is after the crisis? You don't know when they're going to be aftershocks. In the case of the recent crisis, there were many things early on, and then the euro popped up where it was very hard to know what was going to happen next. I think that some of the, perhaps policy corrections that should have been made were based perhaps on overly rosy forecasts of when it would be over. There was certainly a triumphalism early on that it was all okay, and some of the forecasts were too rosy. And I would say concretely, it's not just about austerity, it's also about what you spend on. I think as it evolved, it's clear if you had accepted that it was going to take a long time, that financial crises have a long, slow aftermath. That's something Carmen Reinhardt and I have written about. You might have thought more about doing long-term investment projects because, you know what, if it's still going on in 5 years, that's okay, that you're not necessarily trying to spend it all at once. But this is very difficult. And I think a very difficult decision, and one that worries me the most when we look at the history books and try to draw lessons from this, is how much do you just bail everything out and how much do you have some write-downs? I think that really needs to be looked at. And for example, I think two of the more concrete things were in the case of mortgages. Should the government have just writ large bailed out some of the subprime mortgages with, maybe some kind of equity sharing? Marty Feldstein has a proposal, many others around about that. And of course, I think in the case of Europe, there's some solvency. I mean, there's some liquidity, a lot of liquidity, but there's definitely some solvency in some places. And I think, looking at debt write-downs would have made a lot of sense. Let me just move on to sort of say post-crisis, and just a huge issue, but I think at the end of the day, evolving to a world where we have less plain vanilla debt is clearly what you want to do, because that's how you get debt crises. So Admati and Hellwig have a series of papers and a book now saying that banks ought to have to raise more of their money with equity. It's called capital, but they really mean how you fund banks. I think the spirit of that makes a lot of sense. My former co-author, Jeremy Bulow, who is also a student of Stan's, and Paul Klemper have another version of this where they describe it as banks printing their own money, but you basically get paid in equity when things go sour. And I think these are very good ideas. Also, in terms of having richer forms of debt, Bob Shiller's been evangelistic about having newer forms of debt linked to GDP. Probably doesn't not necessarily the greatest advertisement that Argentina was the first to try it, but I think it is a good idea, and linked to housing prices, linked to commodities. And these involve legal changes. They involve a lot of changes in order to be able to do this. But I think the general spirit of trying to have less plain vanilla debt is where you want to head. And that may involve some regulation. We have regulation about the government having a monopoly over currency, but we allow these very close substitutes. We think it's good, but maybe in their ways it's not so good. Maybe we want to have a future where we all have an ATM at the Fed instead of intermediated through a bank. I mean, there can be some service contracts there. And if you want a better deal, if you want more interest on your money, then you can buy what is basically a bond fund that may be very liquid, but you are not guaranteed that you're going to get paid back in full. And I would think it would be a wonderful future where our grandchildren look at these plain vanilla bond bank deposits like our own children look at DVDs, that's just what? You used to do that? That's so crazy. We don't do that anymore, and I think there really is scope to do that. I do clearly think we need more public education about the financial sector, about finance in general. And I speak certainly of public TV, radio, internet, but much more broadly, hopefully providing balanced analysis, and then maybe helping them understand some of these complicated contracts that they now have to buy because we don't have anything except an ATM at the bank. And then finally, of course, the political system is at the core of all really deep financial crises, and we need reform here. Can we ever not have financial crises? Depending on how you look at it. Well, let me just say, I think the IMF will always be in business. We have a human element, I think, that will be with us for a long time. But I do think that we really can evolve the system more ambitiously and maybe do better. Thank you.
The last speaker is Larry Summers.
I am very glad for the opportunity to be here. I had an occasion to speak some years ago about Stan's remarkable accomplishments at the IMF when he left the IMF. And I had an occasion some months ago to speak about his remarkable accomplishments at the Israeli Central Bank when he left the Israeli Central Bank. So I will not speak about either of those accomplishments this afternoon. Instead, the number that is in my mind is a number that I would guess is entirely unfamiliar to most of the people in this room, but is familiar to all of the people on this stage, and that is 14,462. That is the course number that Stan Fischer's course in monetary economics at MIT for graduate students was. It was an important part of why I chose to spend my life as I have, as a macroeconomist, and I strongly suspect that the same is true for Olivier and for Ben and for Ken. It was a remarkable intellectual experience, and it was remarkable also because Stan never lost sight of the fact that this was not just an intellectual game. Getting these questions right made a profound difference in the lives of nations and their peoples. So I will leave it to others to talk about the IMF and Israel. And I will say to you, Stan, thank you on behalf of all of us for 14,462 and all you have taught us ever since. I agree with the vast majority of what has just been said. The importance of moving rapidly, the importance of providing liquidity decisively, the importance of not allowing financial problems to languish, the importance of erecting sound and comprehensive frameworks to prevent future crises. Were I a member of the official sector, I would discourse at some length on each of those themes in a sound way, or what I would hope to be a sound way. But I'm not part of the official sector, so I'm not going to talk about that. I'm going to talk about something else that seems to me to be profoundly connected. And that is the nagging concern that finance is too important to leave entirely to financiers. We have all agreed, and I think our agreement is warranted, that a remarkable job was done in containing the 2007-2008 crisis. That an event that in the fall of 2008 was, by most of the statistics, GDP, industrial production, employment, world trade, the stock market, worse than the fall of 1929 and the winter of 1930 ended up in a way that bears very little resemblance to the Great Depression. That is a huge achievement for which we rightly celebrate Ben and many others, and that playbook will be a hugely important one the next time there is a panic, and that time will surely come somewhere and someplace. But there is, I think, another aspect of the situation that warrants our close attention and tends to receive insufficient reflection. And it is this: the share of men or women or adults in the United States who are working today is essentially the same as it was 4 years ago. 4 years ago, the financial panic had been arrested. The TARP money had been paid back. Credit spreads had substantially normalized. There was no panic in the air 4 years ago. That was a great achievement, how rapidly that happened. But in those 4 years, the share of adults who are working has not increased at all. GDP has fallen further behind potential as we would have defined it in the fall of 2009. And the American experience is not completely unique in this regard. And this experience is not completely unique, as Ken and Carmen's work has documented, in the wake of financial crises. I remember at the beginning of the Clinton administration, we engaged in a set of long-run global economic projections. Japan's real GDP today is about half of what we believed it would be, what the IMF believed it would be at that time, what the World Bank believed it would be. It is a central pillar of both classical models and Keynesian models that it is all about fluctuations around a given mean, and that what you need to do is have less volatility. I wonder if a set of older ideas that I have to say were pretty firmly rejected in 14462, Stan, a set of older ideas that went under the phrase secular stagnation are not profoundly important in understanding Japan's experience and may not be without relevance to America's experience. Let me say a little bit more about why I'm led to think in those terms. If you go back and you study the economy prior to the crisis, there's something a little bit odd. Many people believe that monetary policy was too easy. Everybody agrees that there was a vast amount of imprudent lending going on. Almost everybody believes that wealth, as it was experienced by households, was in excess of its reality. Too easy money, too much borrowing, too much wealth. Was there a great boom? Capacity utilization wasn't under any great pressure. Unemployment wasn't under any remarkably low level. Inflation was entirely quiescent. So somehow, even a great bubble wasn't enough to produce any excess in aggregate demand. Now think about the period after the financial crisis. You know, I always like to think of these crises as analogous to a power failure, or analogous to what would happen if all the telephones were shut off for a time. The network would collapse, the connections would go away, and output would, of course, drop very rapidly. There'd be a set of economists who'd sit around explaining that electricity was only 4% of the economy, and so if you lost 80% of electricity, you couldn't possibly have lost more than 3% of the economy. And there'd be, there'd be people in Minnesota and Chicago and stuff who'd be writing that paper, but it would be stupid. It would be stupid. And we'd understand that somehow, even if we didn't exactly understand in the model, that when there wasn't any electricity, there wasn't really going to be much economy. And something similar was true with respect to financial flows and financial interconnection. And that's why it's so important to get the lights back on, and that's why it's so important to contain the financial system. But imagine my experiment, where for 3 months or 2 months, 80% of the electricity went off. GDP would collapse. But then ask yourself, what do you think would happen to the GDP afterwards? You'd kind of expect that there'd be a lot of catch-up, that all the stuff where inventories got run down would get produced much faster. So you'd actually kind of expect that once things normalized, you'd get more GDP than you otherwise would have had. Not that 4 years later, you'd still be having substantially less than you had before. So there's something odd about financial normalization, if that was what the whole problem was, and then continued slow growth. So what's an explanation that would fit both of these observations? Suppose that the short-term real interest rate that was consistent with full employment had fallen to -2 or -3% sometime in the middle of the last decade. Then what would happen? Then even with artificial stimulus to demand coming from all this financial imprudence, you wouldn't see any excess demand. And even with a relative resumption of normal credit conditions, you'd have a lot of difficulty getting back to full employment. Yes, it has been demonstrated absolutely conclusively that panics are terrible and that monetary policy can contain them when the interest rate is 0. That has been demonstrated absolutely conclusively. It has been demonstrated less conclusively, but presumptively, that when short-term interest rates are 0, monetary policy can affect a constellation of other asset prices in ways that support demand, even when the short-term interest rate can't be lowered. Just how large that impact is on demand is less clear, but it is there. But imagine a situation where natural and equilibrium interest rates have fallen significantly below 0. Then conventional macroeconomic thinking leaves us in a very serious problem, because we all seem to agree that whereas you can keep the federal funds rate at a low level forever, it's much harder to do extraordinary measures beyond that forever. But the underlying problem may be there forever. It's much more difficult to say, well, we only needed deficits during the short interval of the crisis if aggregate demand, if equilibrium interest rates can't be achieved given the prevailing rate of inflation. And most of what would be done under the auspices, if this view is at all correct, would be done under the aegis of preventing a future crisis, would be counterproductive, because it would in one way or other raise the cost of financial intermediation and therefore operate to lower the equilibrium interest rate that was necessary. Now, this may all be madness, and I may not have this right at all. But it does seem to me that 4 years after the successful combating of crisis, with really no evidence of growth that is restoring equilibrium, one has to be concerned about a policy agenda that is doing less with monetary policy than has been done before, doing less with fiscal policy than has been done before, and taking steps whose basic purpose is to cause there to be less lending, borrowing, and inflated asset prices than there was before. So my lesson from this crisis is, and my overarching lesson, which I have to say I think the world has under-internalized, is that it is not over until it is over, and that is surely not right now and cannot be judged relative to the extent of financial panic, and that we may well need in the years ahead to think about how we manage an economy in which the zero nominal interest rate is a chronic and systemic inhibitor of economic activity, holding our economies back below their potential. Thank you very much.
Good. We now turn to the question part of the panel. First, is there anything that any of you want to take up about what the others said? Ben.
That was a fascinating comment at the end, Larry, about the negative interest rate. I remember another course we had at MIT with Mr. Samuelson, I think is a relative of yours, where he explained, we were talking about Bern Bauwerk or somebody like that. He was explaining why the real interest rate couldn't be negative indefinitely, because he said there was always the possibility of leveling a hill so that the locomotive could, get to a certain destination with less fuel, which meant that there was always a positive rate of return available in the medium to long term. And it seems that if real return is negative, first of all, monetary policy can get negative interest rates, with positive inflation. That's one thing. But on the fiscal side, the return to public investment, as long as it's real, as long as it's above zero, would always be an approach, right? Would always be profitable at negative interest rates.
The occasion did not permit my discussing every aspect of what I have talked about. I do know about Paul's thing about leveling out a hill. If you think about it as a private investment, it requires that there be perfect property rights, that you can get the benefit of that through all of time, which it's reasonable to suppose that you don't. If you think of it as a public investment, it's sort of the point that there may be a case for what would, in some ways of thinking, be a permanent fiscal expansion, in which you are constantly undertaking projects of that kind. And I think it is precisely the question of how one should think about medium-term and long-term fiscal policy that the kind of argument that I made goes to a very substantial extent, and I think that what I was attempting to raise a question about what is almost, I don't know whether you really have it at Alt F6 at the IMF, but you might as well have it at Alt F6, that all policy papers of the IMF, after they say whatever they're going to say, they have the paragraph where they say, and of course, in the long run, fiscal consolidation will be profoundly important so as to maintain confidence and increase soundness of what takes place. I mean, the IMF's most recent fiscal report, there's some question as to precisely how it should be read, but it basically says that every industrialized country in the world is in massive long-run problem with respect to its fiscal situation. And maybe that's right, but if everybody tried to solve it at once, somehow I don't think it would be very good for all the people who are unemployed there. And maybe they can just solve it 2 years from now and then it'll all be okay. But I look at the record of the last 4 years and I think that's much less clear. You said something which I think is worth thinking about. You said, well, if you just get you made the point, which is obviously right, that if you generate inflation, then you can have as negative a real interest rate as you want. It's often assumed from that monetary policy can necessarily solve the problem alone, but that depends upon the ability, as you well know, depends upon the ability of pure monetary policy to achieve any desired inflation. There's no question that if you, to use Milton Friedman's famous line, which you contributed to the popularization of, if you drop enough dollar bills from enough helicopters, there's no question that you can get as much inflation as you want. But in the classic economics lexicon, that is, of course, an expansionary fiscal policy because you're making a transfer. And we've done a lot of quantitative easing, and the inflation rate in the United States is not conspicuously higher than it was before we started. And so the question of in what ways that zero interest rate may bind over the longer term is, I think, an important one. The kind of thing I'm talking about is not a purely hypothetical possibility. I mean, with painting with the broadest brush, the economic history of Japan for the 22 years from 1990 to 2012 has some substantial element of what I was talking about.
I'm going to, again, use the privilege of a chair, ask a question to all four of you. I was struck by at least what I perceived as the implicit assumption that the next crisis is going to be a financial one. And I'm just wondering whether this was intentional or not. It seems to me that there are some fiscal problems on the horizon, maybe not on the scale that Larry accused the IMF of forecasting, but there are potential natural disasters. I think one of the lessons of this crisis is how globalized the world is, how important the supply chains are, how a flood in Thailand has an effect on the world. I'm just wondering whether, in the end, it's really the financial crisis, which are the nasty ones, or this is just the one we got. Any reactions? Any of you?
Well, financial crises are sort of entirely human-made. I mean, they represent entries in books or electronic readings or pieces of paper. This is a very different proposition from a natural disaster, for example, and different sets of tools and different sets of responses. That's the ironic thing about financial crises. They seem to be coming from some sense nowhere. I remember I told a story about asking my grandmother about the Great Depression and her telling me how children didn't have shoes because their fathers didn't have jobs in the shoe factory that had been shut down. And the natural response from a 6-year-old was, well, why don't they just open up the shoe factory? And of course, it has to do with the coordination of individuals in a complicated financial and economic system. And these are evidently very important phenomena. We've seen them in emerging markets, we've seen them in advanced economies, but they seem to me to be a different type of problem than a climate crisis.
Well, I believe you certainly can have fiscal crises. We're looking at the European situation. I think everybody is impressed or worried by the fact that all the forecasts of political instability that were made at the beginning of the crisis seem not to have resulted in major political changes or political crises in Europe at this stage. Question is how long, if Larry's world is only halfway on its way, how long the political situation can continue without governments coming to power that want to do things which create financial crises, which are more based on fiscal policy mistakes than on monetary policy. Now, they may too lead to financial crises, because I'm not quite sure how you define a debt crisis in which government loses the capacity to finance its debts, or in which inflation results from something like that. But there are other sources which almost always, as you think about them, will get linked to some political developments. And we've been very much tied up in our world of the economy per se, without asking how the political, how citizens interact with what's going on in the economy and what impacts that have on the political system and the government.
Well, at first I think we'd all agree with Larry that public investment's too low, and that would make infinite sense right now to do more, because of course it pays for itself, and so it's sort of a non-issue if it's done in a sensible way, and that's incredibly true in the United States, but a number of other countries. I mean, if you're talking about a pure financial crisis, I mean, I think what Stan said I'd agree with. I mean, there's an interaction between fiscal and financial, but I mean, I'm actually incredibly worried about the environment. I favor having a carbon tax, and you know, you can cut other taxes and such, but I think a financial crisis will be first.
I mean, I was trying to reach a judgment about whether there was going to be war in the Middle East before or after there was going to be pervasive bank failures. So in some sense, I took the question to be all about financial crises, Olivier. But I would sort of, in one way, sort of relate to the spirit of your question, which is, seems to me that if you sort of read Kindleberger, the impression you come away with is that there was some combination of complacency and euphoria that preceded each of these crises. And feels to me like we're a way away from complacency and euphoria. And so I don't think it's an accident that there were very few financial crises in the 35 years after the Second World War. I think it had something to do with the fact that people were still careful, in a way, in the aftermath of the Depression. And if you sort of ask me today, in the global economy, are there more problems of underconfidence or overconfidence? I think that's easy. There are many more problems of I could point to some problems of overconfidence, but it seems to me there are many more problems of underconfidence than there are of overconfidence. So I think it's going to be a while, quite a while, before we have another financial crisis that will fit in the 2008, the Nordics in the early 90s, Japan at the end of the 1980s, the Depression, 1907 paradigm. I think that's a long time off. I think those kinds of crises are a long time off. I think in a world of near zero interest rates, various kinds of borrowing can probably go on for a fairly long time. So I'm not sure I see just what other crises within the remit of this panel will happen, unless, and I guess this was another way of thinking about the point of my remarks, unless you think the fact that the global economy is producing $2 to $3 trillion less output than might be regarded as its capacity every single year. And that there are more kids living at home because they can't get jobs after they graduate from school in the industrialized world than there have been in decades. You could regard that as a kind of continuing crisis that's with us today. And I guess that seems to me to be the crisis that ought to be the preoccupation.
Questions? Come to the microphone. There are enough people in the room, but there should be a few questions.
I'm going to be greedy on questions since there aren't a lot of other people. For Larry, what is the shock that has given us a new equilibrium, real interest rate below zero? Number one. Number two, why isn't it just that we've been doing fiscal austerity at the wrong time, and that's why we still have such a big output gap? For all the others, when you do, because there was a lot of talk about liquidity, and it's hard to tell liquidity versus solvency, but the importance of acting quickly. So when you act quickly and do the stress tests, does it really matter if you sort out which is liquidity and which is solvency, or is the important thing just to divide the banks into two piles, like maybe Roosevelt during the bank holiday, and as long as you divide them into two piles and there's some members of each pile and you recapitalize some and wipe out others, that's all that's required? That should keep you occupied for the rest of the time.
Who starts? Larry.
Jeff, I don't think it was thought that fiscal policy was conspicuously austere in the period prior to 2007 and 2008. And I think it's hard to construct a counterfactual for the period 2003 to 2007 with no bubbles and reasonably rapid growth, since the bubbles are now seen as having been the cause of a significant fraction of the growth that there was. What shock could drive equilibrium low real interest rates down? There are a variety of candidates, but let me mention two. The first, in your sphere of expertise, and something Ben wrote about some years ago when he spoke about the savings glut, the substantial flow of capital from trade surplus and current account surplus nations that desired for some reason to accumulate reserves on a substantial scale. That's one answer. A second answer, which I'm inclined to think is more important, is this. The canonical capital good of our age is the computer and is information technology. The relative price of information technology relative to everything else goes down 20% a year. So the same amount of savings is producing vastly more capital than it used to. And so whatever the right savings investment balance was before, you need a different savings investment balance now, precisely because capital goods are becoming substantially cheaper. You know, another way of looking at what I've said is to look at the balance of the private sector or the balance of the corporate sector, where what you see is a very substantial deterioration in investment relative to savings. And without quite extraordinary monetary policy, that would be true to an even greater extent. And part of the reason for that is that capital goods are cheaper. My read is that the most important reason the stress tests succeeded was that they convinced everybody that something was going to be done and no banks were going to fail in a disorderly way. And there wasn't going to be any generalized regime of creditor stiffing. And people didn't know just how that was going to play out, but they knew it was going to play out, therefore they felt better and things got better.
Ben?
There's not a clean distinction between liquidity and solvency, because in a panic, the fire sales result in depressed asset prices, which make some firms insolvent at current prices. So liquidity is the first step. If you restore stability and end the fire sales and let prices find a more sustainable level, then you can find out who's really insolvent, and then that has to be addressed by private or public capital injections, which of course are beyond the scope of the central bank, which is why central bank alone cannot be responsible for ending crises.
Stan?
It does make a difference if not all your problems are liquidity problems, and I assume that there are banks which have better assets and banks that have worse assets, and if they have worse assets and you're supposed to do these tests, it's actually in budget as well, which makes it kosher completely. You're supposed to do these evaluations at more or less normal conditions, not at the crisis conditions. And I assume if you find banks that are broke, it would be better to close those ones than the other ones. If it was all liquidity, well, obviously it doesn't make a difference.
Good.
I would just add, I took Olivier's question about would there be financial crisis anywhere, not would they be in the United States, that in fact, this kind of thing happens extremely infrequently. But if you look at the whole world, that's another matter. I mean, the memories sometimes fade faster, and places that didn't have a crisis are more likely to.
Please.
Larry, I wonder whether the 35 years after World War II had something to do with the fact that financial liberalization hadn't yet happened, and that had something to do with the stability of the financial system.
It surely did. The fact that the stock market kind of went up 15–20% a year every year through the 50s, even though economic performance was kind of lousy and getting worse as it was seen at that time, had something to do with a growing sense that the world would kind of revert to normal and some decreases in the risk premiums. But no doubt, what you're describing is a portion of the story as well, and it's an interesting question, the extent to which one could go back to that in the modern world.
Good. Please.
My name is Gamal Masri. I work at the IMF. I have a question in terms of a lesson learned from the last episode, the recession in the US. Some would say that a lot of policymakers' attention went to strengthening the financial center, Wall Street, and that there was considerable success there. And too little was done to prop up Main Street, meaning the mortgage holders, those who are underwater, and that for various reasons that was left besides. And it took some time for the housing market to recover, hence the delayed recovery. So while we can accept, as Mr. Summers just explained, the importance of the financial sector in terms of providing the electricity to the system, the others might have also been neglected and might have been a reason for the delayed recovery. So I was wondering whether any of you or all of you have any thoughts on that. Thank you.
I was in the administration and was involved in those policies. I don't think anybody involved feels fully satisfied with the way it played out. And I think the pace at which resources were distributed was less than was anticipated or than was desired. But I think much of the commentary does, I think, miss the mark. Everyone understood that housing was at the center of the crisis. Everyone understood that there were opportunities where you had a guy who had a house that was worth $200,000, a mortgage that was worth $240,000, who was about to get foreclosed in a way that was going to turn the house into being worth $100,000, and that if he just got his mortgage reduced to $150,000, he'd be able to pay it, he'd be happier, the community would be happier, the bank would be happier, everybody would be happier. everyone involved in making policy 100% understood that. So the failure to understand that was not the reason for any error, nor was the error out of any kind of excessive loyalty to Wall Street. Everyone would have liked to have done fantastic things for millions of voting Americans. So that's the wrong theory. So what was the issue? And I'm not necessarily saying it was dealt with correctly, but here was the problem. The problem was that there were a set of households like the one I just described, for which if you came along and reduced the mortgage, it would be a Pareto improvement and it would be terrific for everyone. For every one of those households, there were 6 who were paying their mortgage, were just paying their mortgage to their institution every week. They were just paying it. And there were a lot of others who didn't buy a house because they thought they couldn't afford a house. And they didn't want to go excessively into debt. And so the question was, what do you do? What you want to do is do something for the first group and not do something that turns the 6 other people into people who are going into default and needing to be bailed out by taxpayers or putting a major burden on an already undercapitalized financial institution. And so the programs were designed in quite complex ways to target the place where the assistance would be efficacious and to avoid setting off an epidemic of defaults that would either be very expensive for taxpayers or be a major problem for the financial institutions. Now, I think relative to the expectations of the people who designed them, they probably committed more of the error of not reaching people who should have been reached, and virtually none of the error of reaching people who shouldn't have been reached and setting off a set of defaults. But that's easy to say with the benefit of hindsight. If you had created a situation where all over America, people were deciding that they needed to stop making payments so that they could qualify for mortgage relief programs, you could have easily substantially exacerbated the financial crisis. If you had said that the government was going to take on a liability that bore any close to resemblance to the magnitude of the total underwater quantity of equity in the economy, you would have been taking on a vast expenditure. So there may well have been better ways of having done it with hindsight, and certainly the programs evolved to be more active and they didn't set off an epidemic, and it may well be that they should have been that way much earlier. But the theories that it was either stupidity or venality that caused more resources to flow to housing, I guess I would fairly firmly insist are wrong.
Good. Ben, you want to add?
No, that was excellent.
Okay. Good. We have time for probably one more question.
My question, do you think that Europe will be able to achieve a banking union?
You're asking me?
Yes.
Yes, but it's going to take a bit longer, maybe quite a bit longer than the present schedule.
Okay.
Hi, I'm Colin with the Recovery Board. So I had a question in regards to student loan debts and this being a potential cause of a next crisis, because I actually just recently had a conversation with one of the major banking associations' econ departments, and they're very well concerned about this too, just with the pure massive amount of debt students have and just the lack of jobs out there, especially good-paying jobs.
Probably Larry. Student loans.
I was thinking that the chairman of the Federal Reserve was very well qualified to address that question.
So you raised 2 issues. You raised the student debt issue and you raised the jobs issue. And I think that, let me just start by saying that, Larry, you talked about the employment population ratio. I think the unemployment rate probably understates the degree of slack in the labor market. I think the employment population ratio overstates it somewhat because there are important downward trends in participation. But that being said, I think we would agree that there's an awful lot of slack in the labor market and a lot of young people living with their parents and the like, and that's a very important imperative, and why the Federal Reserve in particular is taking strong actions to try to support job creation. So that's a very important issue. Student loans, they are in the first place, I think it's a good thing that we have student loans, obviously. It wouldn't be good if people couldn't invest in their own human capital and make that investment. Unfortunately, student loans are not underwritten in any way, and so we're relying pretty much on the borrower to make the judgment about whether this is a good investment or not, and it's not always a good judgment. In terms of financial crisis, I think it is the case that student loan debt, which is not dischargeable in bankruptcy, for example, is a burden which is affecting, for example, the ability of many young people to buy a first home, affecting other purchasing decisions they might make, affecting obviously their overall financial condition. So in that respect, it is yet one more drag on, to the extent that there's a lot of student debt with people held by people who are not working. It's obviously another drag on recovery. I don't see it as a source of financial crisis per se, simply because it's primarily the asset of the federal government and not of financial institutions. And so what it could be ultimately is another fiscal cost. But I don't see it affecting the stability of the financial system anytime soon. But it is a serious issue, and I think more thought needs to be given into helping people make better choices when they borrow, to make sure that they are making good investments with the money that they borrow.
We've come to the end of the panel. Is there anything that any of you want to add? Good. Well, otherwise, let me thank all the people who have made this conference a success, the authors, the discussants, the panelists. I want to thank some of the organizers, not the long list, but with apologies to the others, let me cite Ayan Kose, who is there, who organized the conference, Tracy Lukadu and Lucia Bono, who are in the back, Chief Moya, Ezgi Öztürk, and finally, Stan, for giving us an excuse to put this conference together, and from which we learned a lot. Thank you very much, Stan.